Hi everyone, and welcome to our new analysis where I will take a look at the asymmetric opportunity on soybean complex. Before I start, however, I have to remind you that all the information in this video is just for educational purposes. It is not investment advice. And if I'm gonna speak about specific financial instruments like futures, spreads, ETFs, and others, it's always just for educational purposes. If you follow us on Twitter, you already know that we have been watching the soybean complex very closely over the past few weeks. And today we will reveal to you what is the reason for our focus on this group of commodities. And we will show you the asymmetric opportunity that has developed here over the past few weeks. I will start by opening the charts I have prepared for today's video. So it will be not these, and maybe, yes, these, this one, and maybe also this one. I hope I didn't forget anything. Yes, and also this one. So here we go. The situation on soybeans has been difficult for a few months because the market is correcting, which all of you are probably aware of. As you can see, the price of soybeans is consolidating, and more importantly, the volatility has contracted since this spring. And that's important because that's one part of the asymmetry I mentioned before, because when the volatility is low, it allows you to place a relatively tight stop loss. And when you compare this undertaken risk with the potential profit, it creates a great asymmetry, and these opportunities are usually very good. That doesn't mean it has to play out as expected, but even if you are wrong, your loss will be small compared to the potential profit. Overall, we think there is a decent chance the price of soybeans will break out and go higher. There are a few reasons for this outlook. The first one is that there was a sufficient shakeout in the positioning, and not just in the soybean market, but also on other major grains. But let's focus on soybeans. You can see the commitments of traders data, the COT index specifically on the bottom subchart compared to the price on the top. And as you can see, for example, from this speculative COT index, you can see that it has dropped from roughly 0.9 to 0.5, which is a significant liquidation in speculative long positions. Of course, it's not as significant as we saw over the previous few years, but you have to keep in mind that was a bear market on grains, and the index or the net positions tend to oscillate in different range during bear market compared to a bull market. And there is no doubt we are in a bull market right now, so I do not expect the COT index to drop as low as we saw, for example, in 2018 and 2019 during the trade war between the US and China. Nevertheless, the commitments of traders data, or the COT index, is not a timing indicator, which means that it can drop further, and that would mean a lower price in the medium term. What I'm saying is just that the data, the positioning data, is sufficiently oversold to allow for the continuation of the uptrend. But let's move on. Another reason why we are becoming optimistic is the seasonality. Here is the seasonal outlook for soybeans. And you can see that the unfavorable outlook since June is about to turn higher and turn around at the beginning of October, because the period of bad seasonality ends in a few weeks, and starting with the beginning of October, there will be a period of strong seasonal uptrend, as you can see from the seasonal curves on the top subchart, but also from the seasonal statistics on the bottom subchart. Especially the months of October and November are very strong for soybeans, because the price went up in 60% of cases over the last 15 and 30 years. So that's strong. These are some strong numbers. But the seasonality and the price action are not the only reasons why we expect a rebound on the price of soybean complex or soybeans specifically. There is more, and I also want to speak about the fundamentals. To be honest, I'm no expert on grains, so you can take my analysis with a grain of salt. But I think the fundamental backdrop is supportive for the prices of grains. And that's because wherever I look, the prices of inputs are rising. The crude oil price and the energies in general are going higher. The price of labor is going up. The fertilizer and so on is going higher. And there are the bottlenecks in the distribution chains. For example, I saw that the South American soybean farmers are worried about the fertilizer shipments from Belarus due to the sanctions on their regime. And we can hear about these problems around the globe. And this is something that can push the prices of these commodities like soybeans, because the farmers have a lot of inputs in their business. And when the prices of these inputs are going higher, they have to adjust, and the price of soybeans and other grains have to go higher. Of course, you can say that all of this is already discounted in the price, because when we zoom out, then you can see that the price of grains or soybeans specifically is already much higher compared to the prices in the beginning of 2020. That's right. However, most of these price increases in the inputs, like the energy prices, are accelerating over the past few months, when the price of soybeans and other major grains are correcting. Moreover, when I take a look at minor crops like canola, oats or rice, you can see that these crops are already going up. I mean, the prices are already going higher. And that's true even over the past few months, when the price of major crops like soybeans were correcting. And that brings me to another important piece of data that we have been watching very closely over the past few weeks or months. It has a lot to do with the first subchart on this chart, which is the canola chart. When I make it larger, you can see that the price of canola is increasing sharply. Moreover, it's consolidating, and it seems to be about to break higher in the near future. But no matter the short-term outlook, I will show you a chart. Where it is? Here it is. That I was watching very carefully over the past few weeks and months. It's the ratio between the price of soybeans and the canola. The truth is, there is a fundamental relationship between these two crops. Both of them are oilseeds, and they can substitute each other. And this is also visible on this chart. So whenever soybeans becomes too cheap compared to canola, it is only a matter of time before it mean reverts back to some normal relationship or normal price ratio. And the price ratio is something that right now is very skewed to the downside, which means that soybeans is very cheap compared to canola. And I think this situation is about to mean revert back towards some more normal values as we have witnessed over the past 20 years. So right now the ratio is somewhere below 1.5, and we are from the 20-year perspective close to the 5-year percentile, which is very low, and that's the reason why I expect the ratio to mean revert. Therefore, two scenarios are possible. The first one is that the price of canola will go down, which means that it will become cheaper relative to soybeans, or the price of soybeans will catch up and go higher. Personally, I think the second scenario is more likely, but in any case, I recommend you to watch this fundamental relationship carefully, because that will be one of the catalysts that, in my opinion, will push the price of soybeans higher. So that's it. We are bullish soybeans. However, the name of this video analysis was not about soybeans, but about the soybean complex. And the reason is that the situation on some products is even more interesting and more bullish than on soybeans. So let's take a look at it. First of all, I will show you the soybean crush spread that is important for the following analysis. The crush spread is an important visualization of the margins of the companies that process or crush the raw soybeans into the products like soybean meal or soybean oil. And you can see there's been a significant drop on the crush spread, and right now we are at around 80, which is a similar level to July 2020 or November 2018 and July 2019. And I think this is one of the reasons why the products, especially the soybean meal, will outperform soybeans in the medium term. And I will show you the price of soybean meal, just the first continuous contract, to make the point. So here we go. I think it's clearly visible that over the past 5 years, whenever the crush spread was so low as it is now, it was usually close to the bottom on the soybean meal, like for example before the latest bull run in the second half of 2020, or even before that in autumn 2017, when the crush spread was at a similar value around 80. So I think this is a strong reason for the outperformance of soybean meal and the products in general. So let's take a look at the price of soybean meal itself. It looks very similar to soybeans, so there is nothing surprising here. It's also consolidating in a sort of a falling wedge, and I think it will eventually break higher. However, this technical pattern is not as useful for precise timing, because the consolidation may continue for some time. The price can even decline further towards 320, but I'm not predicting anything in this case. The important thing is that it's behaving similar to soybeans. What is interesting, however, is that this market is much more oversold than soybeans, as you can see from the commitments of traders positioning data. For example, the large speculators are even net short, which is a huge difference compared to soybeans, because they were positive on soybeans. Whenever they have been negative over the past few years, it was usually close to a tradable bottom. But once again, the commitments of traders' data do not serve as a timing indicator. The point is that there is a lot of fuel for the potential upside. So once the price turns higher, it will probably move quickly. And let's not forget the seasonal outlook for soybean meal. It is also great in the upcoming few months, as you can see on this chart. Both the seasonal curves and the statistics below are very supportive for upside, for the move higher on the soybean meal. So I would say this looks really great, and that's one of the reasons we were just watching the price over the past 2 weeks, because we were waiting for this seasonally negative period to pass, and that will happen exactly at the end of September. But keep in mind that seasonality is not something that works 100% of the time. It's just some tendency of the price to move in a certain direction, but it's very imprecise. But in this case, when we take this into connection with the positioning and the bombed out sentiment on soybeans, I think this fits perfectly to our bullish thesis. And finally, let's take a look at our last chart, which shows the behavior of spreads across the soybean complex within a single crop. The first one is the spread on soybeans, below is the soybean meal, and finally the soybean oil. The weakness on the spreads was one of the reasons why we avoided grains over the past few months, simply because it was the manifestation of the weakness in the physical market. But we think that these spreads are maybe about to turn higher, because the soybean oil, the spread on soybean oil, the blue one, is already trying to bounce off the zero level. Maybe it is even breaking above this falling trend line, who knows. So the signs of strength are most visible on this spread, but even the other spreads on soybean meal and soybeans are drifting higher at the same time when the underlying is going sideways or down. So maybe they will turn higher in the near future, and that will be the most important confirmation of our bullish thesis. So that's the reason why we are watching these spreads very carefully. And on the other hand, if they turn lower and break down, that would mean our bullish thesis is wrong, and we'll simply pass this opportunity. And the second reason I'm showing you this chart is that it looks like the spreads themselves are even better opportunity than the underlying. For example, when I go to the trading signals generated by the artificial intelligence on SpreadCharts, you can see there are bull spreads on both soybeans and soybean meal in the app, and the signals. The signal on this bull spread on soybeans has recently turned valid, which means that it crossed the 1.0 threshold. So our model likes the opportunity, and the signal on soybean meal spread has been in the app for some time, for a week or two. I'm not totally sure, but you can see that it's valid since the middle of September, when the spread was even lower than it is now. So this is an important piece of information, because it just tells me that the unbiased look at the situation from our model confirms our human outlook, or our human understanding of the situation. So it's sort of a confirmation. And like I said, these bull spreads are probably even better opportunity than the underlying commodities. They have a terrific risk-reward ratio, but on the other hand, they have a bad win ratio. That means that these bull spreads usually fail. They are usually losing trade. However, when they succeed, when they run, they tend to run hard, which means that the profits are usually huge when these spreads turn higher and run higher. But as I said, they usually fail, so these spreads are usually losing opportunities. Therefore, it's necessary to have a strict risk management when trading these spreads. But this is something that's very individual to each trader, and I won't go into this because we are not doing investment advice. This is strictly educational, so it's up to you to do your own analysis and decide if this opportunity is interesting to you or not. From our point of view, it is an interesting situation that at least you should look at. And it's probably all from me for today. Thank you for watching this video, and see you next time.